TheoTrade. This is Don Kaufman. It's May 24th, 2019, and you are watching the TheoTrade Weekend Update. Well, it's Memorial Day weekend here in the U.S. For those of you not necessarily in the know, well, that constitutes a 3-day weekend, plenty of time to think about some of the trades you did last week. Some of the trades are going to be due this next week. Nevertheless, we're going to be coming into a 4-day trading week. The equity markets, effectively the bond markets, are closed on Monday, along with TheoTrade, and we'll be back at it all throughout the course of, Tuesday through Friday next week. With that, I want to talk a little bit about some of the trade this past week, but more importantly, of course, moving forward. The other aspect I really want to discuss in depth, and we'll get to this in the charts in a couple of moments, is we appear to be right on the verge of what I would kind of term getting ugly again. We're right on the edge of dropping back into the volatility box. That's a volatility box that we were discussing all the way back in October of 2018. For those of you that do not recall, that volatility box was anything under about 2,800 in the S&P. So the moment we drop under 2,800 in the S&Ps, which we effectively tested this week in midst of, again, some volatility. So we're going to test under, very likely, the 2,800 marker, and things are going to just get wild and ugly, and that's when volatility is likely to pick back up. But me just saying it, why? Why do I actually believe that we're about to get ugly? And that has everything to do with a couple of very, very key ETFs that I've been watching over the last couple of weeks, and it's just been astounding. Capital is just flowing into these ETFs, and these ETFs are extraordinarily defensive ETFs. One of which we're going to look at here in a moment happens to be the real estate ETF. Another one happens to be the utilities, which is none other than XLU. XLU has been ripping to the upside. And last but not least happens to be consumer staples, which I happen to take a position in the consumer staples. That is XLP. Again, XLP. So when you take a look at these three, again, they're highly defensive sectors, or so we believe, and the amount of capital, the inflows to those ETFs, it's just become downright alarming. This is a duck and cover kind of a measure in the broader marketplace. So again, we believe based on those. Now, I can't tell you if this is going to happen, next week, but I can tell you that we're very likely to see, again, some fairly extreme volatility in the coming weeks and coming months. I mean, summer is not necessarily going to be docile. I'm also going to discuss here in a couple of moments a few positions I took. Again, one of them happens to be an XLP. Another one that we took yesterday happened to be long the pound. Again, there's some big changes coming in Britain, so we figured a change in Britain would just echo a change in the direction of the pound. That's kind of playing out a little bit. The other aspect I want to discuss here kind of momentarily has everything to do, once again, with implied volatility. This past week of trade, we got kind of volatile. The S&Ps were pinging back and forth between gravity points. For those of you who don't necessarily look at gravity points, the gravity points I'm discussing, 2842 inside of the S&P futures, all the way down to 2811. Then we pinged right back up to 2842. It's a party, people. That's the kind of action that you live for as an intraday trader. But the disconcerting portion of that is, so I'm talking about volatility. We're pinging back and forth between these gravity points. The historical volatility, that is actual movement in the markets, is decent. In fact, I talked about that quite a bit last weekend. The implied volatility, though, still not doing it. Okay, and I can kind of summarize that in a nutshell. The marketplace right here, right now, it has seen a lot of trade right in this 28 kind of 40 range. It's seen a lot of trade over the last few months right and around the area we're currently at. So for the most part, the market's saying we've seen this movie before. It's not unusual for us to see this this 28 kind of 42, this 2811, and therefore the implied volatility doesn't necessarily pick up. However, we also would kind of summarize that if the marketplace crosses under 2,800, once again, implied volatility is going to explode, and it's going to become Mr. Toad's wild ride. So we're going to put a lot of the pieces of the puzzle together for you. I mean, you got bonds. I mean, come on. The bonds are trading, specifically the ZB is trading over 151. Have you looked at the 10-year interest rate? And we've dropped down, 2.3%. We could be looking at 2.2% on a 10-year really soon. You look at the bond market, which is flying, okay? You look at real estate, which is, again, a defensive sector. We'll see how long that lasts, but it's a defensive sector. A lot of the REITs and so forth pay some big dividends. The XLP, which is consumer staples, the way the marketplace ultimately thinks is, hey, if it all goes up in flames, everybody needs to buy stuff like, from Procter & Gamble, toilet paper. Procter & Gamble is actually one of the biggest constituents, if you will, of the XLP. And of course, utilities. Okay, if it all goes up in flames, everybody's going to need utilities. And again, those sectors right now are exploding to the upside along with the bonds. And you look at this marketplace and you got to think to yourself, people, something has got to give. With that, let's get into it. Let's show you a couple of charts, a few trade ideas that we're doing right here, right now. All right, to the charts and trades we go. Allow me to start right here inside of the SPX, as I do on many of these weekend kind of updates. One of the first points that I really wanted to make had everything to do with historical volatility and implied volatility. Now, implied volatility, the implied volatility that you're charting here on thinkorswim, this is a VIX style 30-day implied volatility. Effectively, what I'm saying is by looking at this implied volatility, you're kind of gauging what is the market risk supposed to be, for instance, 30 days from now. Now, the historic volatility, and this is average over the last 10 days, historical volatility it's looking backwards at the last, 10 days. So one is very forward looking and one is very, backward looking. But the point that I want to make with this, all right, is a very, very important one. And that is, would you have considered this past week of trade relatively volatile? Okay. Well, right here, historical volatility says, yeah, this has been a volatile couple of weeks, right? In fact, you can actually peg that volatility. And this is, again, it's average over the last 10 days. You can peg that volatility about 17%. But the implied market is really only paying you at a rate of 15%. Again, that's forward looking. It's just like the implied volatility. It's just not paying attention. And again, we've got a couple of kind of guesses as to why. Because if I cruise over here, and I'm actually going to clean up the chart. I'm going to clean up the chart. I'm actually going to drop you into the S&P futures, and I'm going to show you, this is just a 30-day 1-hour chart. Let me go ahead and close up this left side bar. Okay, we're going to get serious right now. When I take a look at this, what I was saying is the market is just saying that this range that we're currently in, and these are those gravity points I was talking about right here, is that right where my line is. That's 28.42 right down here. Okay, happens to be 28.11. All we're doing right now is just pinging back and forth. And the market's kind of saying to you, this is old hand. Again, we've seen this move before. Let's get to the, let's cut to the chase. Now, I'm going to back up a little bit further than that. Now I'm going to back up 100. Again, we are 180 days on a 4-hour chart, right? So I'll highlight this 180 days, happen to be a 4-hour chart. Because a moment ago, I was talking about in the video section, again, we kind of feel, okay, not dissimilar to what we were doing, back in kind of this range. We were a lot higher at that point. We were all the way up at 2,900, but we feel like we're about to drop right back into this kind of wild volatility box. By the way, this volatility box takes us from 2,800 pretty much smack down to 2,600. And again, we've tested there a number of times. And I'm just highlighting, when I say we've tested there, zoom in really quick. Okay. We have tested, albeit briefly, under. All right, that's right there is the 2811. We've even touched into 2800. But to get really highly specific, you got to come under 2800 to start to feel the fear in the marketplace, right? And the volatility will really start to kick into high gear. Now I'm going to switch gears for a second, right back to the SPX. And the reason I'm cruising back to the SPX, and I'm actually going to take you into a 9-month daily chart. The SPX this week, okay, did have a down week. All right, we closed down, which is that of critical importance here? Well, absolutely not. We did touch the lower edge of the expected move. What is kind of important though is, given some of the volatility that we've seen, and again, we're about to move into, all right, a 4-day trading week. Last week, the expected move was about $54, okay? This coming week, which is only going to be a 4-day week, is still projecting right around a $47 anticipation of movement. So once again, okay, you can't, by any stretch of the imagination, you can't call the volatility quiet. But at the same time, actual movement in the market is rocking. And I just don't feel like implied volatility is paying you to take that kind of risk, even though we ended up inside of what was expected, right? By the way, this is that $54 move I was just talking about a moment ago. That's a $54 move. Look at that. I mean, it's absolutely uncanny how we can literally touch right into the edge of expected and we bounced right off of it. Keep that in mind for those of you, again, if you're trading on a week-to-week basis over here, you're trading on an intraday basis, you need to know where those expected moves happen to effectively be. All right, so again, as I zoom out, okay, we look at this, and I'm actually going to pop the spiders in here because I think the spiders are probably cleaner. We look right now like we're on the verge of dropping back into the volatility box, but I want to make this, okay, absolutely, unequivocally crystal clear. My belief in the market dropping back into this box has nothing to do, okay, with what we're doing here in the S&Ps. It just doesn't have to do with that, okay? I rarely look like, I don't look at technical analysis and think to myself like, oh, this is oversold, this is overbought, okay? That's not going to play for me. What is actually going to play is when you start looking at the broader marketplace, and here's again, we're going to throw in a couple of, opinion and a couple of trades over here. You take a look at the bonds, okay? The bonds are trading what I constitute as, this is Armageddon trade, okay? What does the bond market seem to know that the rest of us haven't figured out yet? Because the bonds are going to the moon. They're taking interest rates down, right? They're taking interest rates down before the Fed doesn't have to do anything, right? Does the Fed have to drop interest rates in, September, okay, or their December or even the January of 2020 meeting? No, because right now we're just dropping interest rates. By the way, that's the ZB. If you compare the TNX, I was talking about this, we're sitting here at what, 2.3% on the 10-year. You open up like a 3-year chart. Hey, listen, 2.2% on a 10-year, that is within striking distance. I mean, even 2% on a 10-year is within striking distance. We're not that far removed from like a 1.3% on the 10-year, which is, again, it's just like mind-numbingly low interest rates, especially, okay, when we're supposed to believe that the economy is recovering. And yet you hear about economic slowdown, the interest rates are telling you something about this. They're saying, oh, it's slowing down. If you don't believe the rates, okay, if you don't believe the rates, take a look at the XLU, all right? This is the XLU. Now, let's just cut to the chase and pull up a year-to-date percentage, all right? It's utilities. This is not Google. This is not like reinventing, the world over here. It's utilities. Should, okay, they be rocking by the tune of 15% over here? I don't necessarily believe so. I mean, I get it. They pay a 2.88% div, which right now is a heck of a lot better than the 10-year. But the way you got to look at this, these things broke out. This to me is a big sign, duck and cover, right? So, all right, we threw up the XLU. Great. I'm going to pull up, okay, real estate right now. Real estate. Now, yeah, the interest rates are going down. Interest rates are going down, but the real estate sector is absolutely on fire. You'll probably think to yourself like, yeah, that makes a lot of sense. But, okay, I look at this. They're going after the dividend in here. Again, this seems to be duck and cover. Now, will the real estate sector stay up? This is, again, most of these are, different types of REITs and so forth. Is this thing going to hold up if the S&Ps start to crumble? That's a completely different story. And the last one over here, which I absolutely took a position in, is the XLP. The XLP, which is up about 14%. You got to take a look, though, at the XLP, right? Just open it up 20 years. I just want to throw this out here. See, the thing that really bothers me about the XLP, all right, first of all, back to the year-to-date percentage. It's up about 14%, as I said a moment ago, and the XLP continues to kind of get bid a little bit higher. Now, before I even display why, okay? I'm going to tell you right now, I took a short position in the XLP, okay? I took a short position in the XLP. I'm going to show you, okay, how I took the short position in the XLP here momentarily. But, okay, the reasoning is simply this. It's consumer staples. This is an ETF that, it's got like Procter and Gamble in it. It's just got a number, okay, of products that you would think are just that, like the Walmarts of the world. They are absolutely staples. It's being used, it appears right now, as a defensive, okay? Why did I take a short position in here? Well, kind of twofold. Number one, let's say that the S&Ps tank, all right? So the XLP versus the S&Ps. Is this XLP susceptible to a down move? Like, is this thing going to tank if the S&Ps tank? My argument is unequivocally yes. Okay, the XLP should tank if the market tanks. Why? I don't know. I just look back over like the last 5 years. Every bout of big volatility, every bout of volatility in the markets in the last 5 years, the XLP has been right there. Okay, need I go further than even in like, here's 2018, right there's 2018, right? Okay, 2018, we started off with an explosion to the upside. This is that huge volatility event. And we exploded back to the upside. This is dropping into the volatility box. This is actually December. Right here is December of 2018 where it was tanking. This thing is straight up. Okay. First of all, I love the risk reward in here. I love getting short a product that has been what? Straight up for umpteen weeks in a row. All right. This happens to be a weekly chart. I also fully recognize that this product, okay, now we're actually going to take it into a 3-year daily. This product is absolutely going to feel volatility if the marketplace tanks. Now, what happens if the S&Ps don't tank? Well, if the S&Ps don't tank and this is being used as defensive, wouldn't it stay relatively flat? Right? Because if the S&Ps turn around and they start to rally a little bit, people don't necessarily need to buy, okay, consumer staples as, again, risk on, risk off. Think about that one for a second because it's a fairly complicated trade in the easiest possible manner. If the market tanks, this is likely to go with it. If the S&Ps rally, I actually surmise this will probably stay relatively flat. How did I actually take the position? I used a deep in the money. Okay, I used a deep in the money put as a synthetic short stock position. All right, I mean that's again one of the trades that I've put on. Now that also leads me to want to talk about for just a moment what is a duration position. Here in the XLP and a number of positions I've been putting on lately are what I would term duration. What does duration mean? In excess of 3 months, okay? If you look at the marketplace as a whole right now, and I'm just going to snap back to the spiders for this, close up this left side bar for a second. If you look at the marketplace as a whole, listen, on an intraday basis, there's been some pretty phenomenal trade. Like, look at the intraday trade just the last couple of weeks. This is kind of what I call like Mr. Toad's wild ride. These are wonderful ranges. Can't ask for better than that. And these ranges, though, they're like on an intraday basis, it's, they're being driven by news, by Twitter. It's tweet-twastic, as I said, like last weekend. You got to keep your head about you. So on an intraday basis, I think there's some great setups. Okay. Clearly on a duration basis. Now, a duration basis, again, duration, it's not here. It's not here. Okay. Duration is out here. It's out in excess of 3 months. I think there's unbelievable opportunities out there. I just don't think a lot of people are like, they're not looking at that. Only thing professionals are looking at right here, right now. Algorithms, okay, are sub-second. They're trying to make what? Fractions of a penny and do it tens of millions of times. They don't even care 3 months from now, okay? They're not trying to handicap the marketplace out 3 months from now. The most difficult time frame, unequivocally, is the positions that you hold overnight, the positions that you have on for like 1 month. Why are those the most difficult? Because on a day-to-day basis, we're being shifted by trade war. Okay, trade war news comes out overnight. All of a sudden, Fed news, Fed speak. It just goes on and on and on and on of the merry-go-round of risks. Intraday, spectacular. Duration, spectacular. That kind of middle duration where you hold positions for a month or 2 months, okay, those are the tough ones right now. That's actually why my portfolio, my options portfolio right now, doing a lot of intraday and I'm doing a ton of duration. Okay, in this like in-between area, I'm using infinity spreads. Infinity spreads are those kind of trades where if we have a really big move, either higher or lower, Okay, we have a degree of profitability. Everything in here is relatively flat. This is something, okay, as traders, you need to think about. How are you allocating your capital right now? Again, I personally find it difficult to try to handicap what the marketplace is going to do a week from now. As I said, we look like we're on the verge of dropping back into this volatility box, okay? But I don't know if it's going to happen right away this next week, okay? There's constant catalysts kind of striking this marketplace. And each one of those catalysts, okay, it's only going to take a little bit of a push to ignite that volatility. And effectively, before we know it, we'll drop right back in here. And that's when things just are going to get downright nutty. You got to keep, okay, your capital allocation relatively under control, okay? You got to look at not just like, if you wanted to take a position in Google, you don't just look at Google. You don't look at the chart just on Google. The marketplace throughout the course of the last few weeks has been seeing high degrees of correlation. What that means is if the S&Ps are up, everything's up. And if the S&Ps are down, everything is down. I mean, today, this being Friday, yeah, this was a little bit of a slop fest, right? It was a slop fest. We're coming into a 3-day weekend, okay? Nevertheless, think about the marketplace as a whole right now. No matter what you do, okay, it's going to have a correlation predominantly to these spiders, which are this Nasdaq. I want to thank everybody for joining us here at TheoTrade. Have a wonderful Memorial Day weekend. Bye-bye.